Welcome to the Pro Ticker Deep Dive.
It's great to be here.
Though, looking at the screens today, I'm not sure great is the word I'd use for the markets. It's Friday the 13th, February 13th, 2026, and it feels a little on the nose, doesn't it? It is just a sea of red out there.
It's ugly. I was just looking at the heat map right before we came in here, and it honestly looks like a crime scene. Just blood red everywhere.
It really does. And it's not just random stocks. It's the big ones, the ones that have basically propped up the entire S&P 500 for, 2 years now?
Pillars of the market.
Exactly. You've got NVIDIA down, almost 2% as we speak. Microsoft is slipping about 0.8%. Apple's taking a hit. It feels like, that sound a balloon makes when you let the air out slowly? That hiss.
Yeah, that's a good way to put it. That's what it feels like. And I think we know why.
Yeah.
For the last couple of years, let's say 2024, 2025, we were in what I would call the magical thinking phase of AI.
The AI hype phase.
Yeah. The hype phase, exactly. It was a true rising tide lifts all boats moment. Any CEO could just get on an earnings call, whisper the words generative AI, and the trading algorithms would just trip over themselves to buy the stock.
Didn't even matter if they had a product.
It didn't matter at all. It didn't matter if they had a plan. It didn't matter if there was a path to actually making money from it. It was it was pure promise.
Pure hype.
The promise phase, yeah. But based on everything we're seeing today and looking at the mountain of research we have in front of us, that phase is over. It's officially dead.
And what's replaced it?
We have now entered the AI execution phase, or as I like to call it, the prove it phase. And the market is having this very sudden, very painful awakening that proving it, well, it's going to be the most expensive project in the history of capitalism.
And it feels like investors are finally getting the bill for the party. You have these tech giants promising to spend these just astronomical sums of money. And it's putting their whole identity as cash printing machines at risk.
It is. And at the exact same moment, they're facing this incredibly aggressive regulatory crackdown from the FTC. It's a perfect storm.
So that's our mission for this deep dive. We're going to try and make sense of this storm. First, we have to unpack this staggering number. A $680 billion capital expenditure bill that the tech giants are footing for 2026.
A number that I guarantee you is giving CFOs and investors nightmares.
Then we have to look at this bizarre financial instrument that's popped up. Alphabet Google is issuing something called a century bond. They're literally borrowing money from the year 2126.
Which, as we'll discuss, brings up some, let's just say, some very uncomfortable historical parallels.
The Motorola moment. Yeah, we'll definitely get into that. We also have to analyze this intense regulatory pressure that's building on Apple and Google. It's all about political bias, and the historical comparisons being made are, frankly, chilling.
They are.
And finally, we've got to look at Tesla, at Elon Musk's incredibly risky pivot from cars to robots.
It really is a historic moment. A massive gamble is happening on 3 different chessboards at the same time: financial, regulatory, and technological.
All right, so let's start where it all begins, with the money, the sticker shock. I was reading through the CapEx projections you sent over for the Magnificent Seven, and I genuinely had to read the numbers twice. I thought there was a typo.
It looks like a typo, doesn't it? The numbers just don't seem real.
They don't. So just lay it out for us. What collectively are we looking at for 2026?
Okay, so let's set the baseline. In 2025, which everyone at the time thought was a ridiculously heavy spending year, right?
Right, that was already seen as the pick.
The peak. The Mag 7 collectively spent around $400 billion on capital expenditures. So that's your data centers, your infrastructure, your chips, all of it.
$400 billion. Already a record.
A record by a long shot.
Yeah.
Now, for 2026, the current projections, if you add them all up, are for over $680 billion.
680.
Billion. It's a nearly 70% jump year over year on an already record number.
I just want to pause on that number for a second. $680 billion. It's so easy for us to just gloss over the word billion because we hear it all the time. But just to give everyone listening some context, that amount of money is larger than the entire GDP of Switzerland.
Wow.
It's larger than the GDP of Sweden. It's more than most countries on Earth produce in an entire year.
Here's the one that really got me. I was looking this up. If you take the entire Apollo program, everything it took to put a man on the moon, developing the Saturn V rocket, the command module, mission control, all of it, if you adjust that entire cost for inflation into today's dollars, It's about $257 billion.
So you're saying that big tech in 1 year,
And one single year is spending the equivalent of nearly 3 Apollo moon landing programs.
that's simultaneously awe-inspiring and terrifying. It's not an investment cycle anymore. That's an arms race.
It is the absolute definition of a technological arms race. And it has the same brutal logic as any military arms race. If you don't spend, you fall behind and you lose. But if you do spend, you risk bankrupting yourself before you even get to fire a shot. It's a terrifying catch-22.
So let's look at the scorecard. Break it down for us, because this spending isn't spread out evenly, is it? Who's writing the biggest checks?
The undisputed heavyweight champion of CapEx for 2026 is Amazon. Andy Jassy is absolutely not messing around. They are projecting a spend of $200 billion.
200 billion, just Amazon.
Just Amazon. That's up from an already massive $131 billion last year. And when Jassy gets asked about it, his public line is, quote, very high demand for AI compute. But we need to peel that back a bit. What does that actually mean? What are they buying?
It's not just cardboard boxes and, more delivery vans.
No, not at all. A big part of it is the traditional stuff. Concrete, steel, real estate. They're building data centers, these massive city-sized server farms, at a pace the world has never seen. But the real story is inside those data centers. A huge, huge chunk of that $200 billion is going directly into silicon.
Into chips.
Into chips. But here's the key. They aren't just writing a check to NVIDIA for all of it. They're spending a fortune fabricating their own custom chips, their Trainium and Inferentia chips.
Which is a crucial point we'll come back to when we talk about NVIDIA's position. They're not just buying the shovels for the gold rush. They're trying to build their own better shovel.
Precisely. They're building their own brain, and then right on Amazon's heels, you have Alphabet, Google. They're putting down $180 billion.
That's nearly double what they spent the previous year.
It's a massive jump. And you have to understand, for Google, the stakes are, they're existential. This isn't about growing a side business like AWS. For Google, this is a fight for the company's life.
Because if search gets replaced.
If search gets genuinely replaced by a better AI, whether it's from OpenAI or Perplexity or someone else, Google's core revenue stream, that fire hose of ad money, it doesn't just shrink. It goes to zero.
So that $180 billion isn't an investment budget. You're saying it's a defense budget.
It's a defense budget. They are spending it to survive. They're pouring it all into their Gemini models, into their DeepMind research labs, and, like Amazon, into their own custom silicon, the TPUs.
It's like they're trying to build a moat to protect their castle, but the moat is just made of $100 bills.
That is exactly what it is. And then right behind them, you've got Microsoft. They're on pace for about $144 billion. A lot of that is, of course, just feeding the OpenAI beast and building out Azure to handle it.
And Meta, what's Zuckerberg up to?
Zuck is looking at a range of somewhere between $115 and $135 billion.
It's funny. I have to laugh when I hear that. I remember, 3 or 4 years ago, the entire world was screaming because Zuckerberg spent $10 billion on the metaverse.
Oh, it seems so quaint now, doesn't it? It's adorable. Oh, no, $10 billion? The company is doomed?
Right. It was seen as this reckless, insane bet. And now he's casually dropping more than 10 times that amount on his superintelligence labs.
And this time, nobody is questioning the ambition. They're only questioning the bill. They're looking at that number and getting very, very nervous.
But there's one name in the Mag 7 that we haven't mentioned in this spending spree. There's a glaring outlier here.
Yes, there is. The prudent one. Or, depending on your perspective, the one that's about to be left behind. Apple. While Amazon is out there spending $200 billion, Apple's projected CapEx for 2026 is about $13 billion.
13. 1-3. That's not even a rounding error for Amazon. That's like their coffee budget.
It's nothing. And this is the great debate that's dividing Wall Street right now. There are two very distinct schools of thought on this.
Okay, what's the first one? The bull case for Apple.
The bull case is that Apple is just being brilliant. They're capital efficient. They're sitting back, watching everyone else spend themselves into a hole, building the superhighways of AI. And then, when the roads are built, Apple will just cruise onto them in their beautifully designed Ferrari and sell a premium service on top of it.
Let everyone else do the dirty work.
Exactly.
Yeah.
Why build the power plant when you could just buy the electricity and package it nicely for the consumer?
Okay, so that's one school of thought. What's the other one? The bear case.
The other school says Apple is fundamentally misunderstanding the new paradigm. They're making a catastrophic mistake. In the AI era, compute is the product. Intelligence is the product. If you don't own the data centers, if you don't own the massive training clusters for the models, you're not a leader. You're just a tenant.
You're renting your intelligence from Google or from OpenAI or Microsoft.
Exactly. And for a company like Apple, whose entire brand is built on controlling the whole stack, from the silico in the phone to the software on the screen, that is a very vulnerable and very un-Apple-like place to be.
It's a huge strategic gamble. But let's dig into the consequences of all this spending. Because you mentioned earlier that these companies are putting their status as cash machines at risk. Unpack that for us.
This is maybe the single most critical point for any investor listening to this to understand. For the last decade, why did you own big tech stocks? Why did you own GOG or MSFT or Meta?
Well, for growth, sure, but also for safety. For the margins, they were unstoppable money printers.
Exactly. They printed cash. They had software margins. That's the key. You write the code once, you sell it a billion times.
Yeah.
The marginal cost of selling one more copy of Windows or showing one more ad on Instagram is basically zero.
And that creates massive free cash flow.
FCF, the holy grail for investors. It's the cash left over after you've paid all your bills and reinvested in the business. And these companies generated mountains of it.
Right.
But now, they're fundamentally pivoting their business model, whether they admit it or not. They are starting to act less like software companies and more like 19th century railroad companies or 20th century utility companies.
Yeah. Explain that. What do you mean by utility companies?
If you're a utility company, you have to build a giant billion-dollar power plant before you can sell a single kilowatt hour of electricity. You have to spend a fortune laying the copper wire under the streets. All that money goes out the door up front.
And you don't get paid back on that power plant for maybe 20 or 30 years.
Precisely. That is the monetization gap. They are spending $200 billion today to build the AI power plant. But the actual revenue from the new AI agent they sell, or that enhanced cloud service, that might not show up in a meaningful way for 3, 4, 5 years.
And in the meantime, from an accounting perspective, that spending just crushes your cash flow.
It absolutely obliterates it. Look at the numbers in the analyst notes for Amazon. We're talking about serious analysts at places like Morgan Stanley and Bank of America. They're projecting that Amazon's free cash flow might actually turn negative in 2026.
Negative.
No.
Amazon, the company that basically built the flywheel concept, the infinite cash loop from Prime and AWS.
Negative. They are on track to be burning more cash than they bring in. And it's the same story over at Meta. Their free cash flow is projected to drop by nearly 90%.
A 90% drop. I mean, if you're a value investor or a dividend investor or anyone who cares about fundamentals, that is a 5-alarm fire. That's a sell signal flashing in giant neon letters.
It is. And we're seeing that reflected in the retail investor sentiment. You look at the chatter online and people are looking at Meta's operating margins, which are compressing. They're down to 41% from a high of 38%. And they're saying, wait a minute, this isn't the company I bought.
Yeah.
The efficiency, the thing that made it so attractive, is disappearing before their eyes.
It really feels like a regime change. It's a fundamental shift from asset-light tech, which is what we've known for 20 years, to asset-heavy tech.
That's the perfect way to phrase it. They're becoming industrial giants. And when you become asset-heavy and you're bleeding cash to fund these massive projects, you have to start doing some, let's say, creative things to keep the lights on. You have to get very creative with your financing.
Which brings us perfectly to what is easily the most bizarre financial headline of the week, maybe of the year. The Century Bond.
The 100-year wager.
Let's unpack this slowly because it's so strange. Alphabet, the parent company of Google, just issued a bond. It's a debt instrument. They're borrowing money. The maturity date on this bond is the year 2126.
2126.
I mean, okay, let's just sit with that.
Yeah.
I won't be here. You won't be here. My children will likely not be here.
There is a non-trivial chance that the United States of America as a political entity might not be here in its current form.
Right. So walk us through the logic. Why on earth did a company like Google, with tens of billions in cash sitting in the bank, need to borrow money from our great-great-grandchildren?
Okay, so let's start with the why. As
Yeah.
we just established, they have a $180 billion bill to pay this year. And they're probably going to have another one just like it next year and the year after that. They need a constant flow of cash.
You need liquidity.
They need massive liquidity. Now, they have options. They could bring back some of the hundreds of billions they have stashed overseas. But if they repatriate that cash, they'll have to pay a huge tax bill on it.
Okay, so that's out.
Or they could issue more stock. But if you issue new shares, you dilute all your existing shareholders, and the stock price usually takes a nosedive. The investors hate that.
So they go to the debt markets instead.
Exactly. They go to the bond market. And inside the CFO's office at Google, the logic is probably pretty simple. They're looking at the world and thinking, okay, interest rates are relatively stable right now. If we can lock in a low interest rate for 100 years, inflation will eventually make that debt worthless. It's basically free money in the long run.
Right. So on a spreadsheet, in a vacuum, it looks like a clever bit of financial engineering. You get the cash you need today, and you pay it back a century from now when a dollar is only worth a penny.
Exactly. So that's the CFO's argument. But the market isn't a spreadsheet. The market is about psychology. It's about signals. And this is what people like Michael Burry, the guy from The Big Short, are screaming about online right now.
He's calling this the Motorola moment.
The Motorola moment. And this is where it gets really interesting. See, it is incredibly rare for a technology company to issue a century bond. It just doesn't happen.
Why not?
Because the entire premise of technology is rapid, unpredictable change. Who, in their right mind, would lend a tech company money for 100 years? Who knows what the world will look like? The last major tech giant to have the, let's call it hubris, to do this was Motorola.
Motorola. I honestly haven't thought about a Motorola Razr flip phone in probably 15 years.
But that's the point. In 1997, you couldn't escape them. They were the kings. They were it.
So back in 97, they were a bigger brand than Microsoft at the time.
In terms of brand recognition and cool factor, absolutely. They were the undisputed lords of mobile communication. They were seen as completely invincible. And because they felt invincible in 1997, they issued a bond that wouldn't mature until 2097.
Okay. And then what happened?
What happened next is a classic business school case study in disruption. The market peaked. The world shifted from analog to digital. Nokia came out of nowhere with smaller, better phones. And then, of course, the iPhone arrived. It was the final nail in the coffin. Motorola completely missed the transition. They collapsed. They were sold off for parts.
So the Century Bond wasn't a sign of strength. It was the bell ringing at the top of the market. It was a signal of peak hubris.
That is the bear case, 100%. The argument is that issuing a 100-year bond is a sign that management has become so high on their own supply, so completely convinced of their own permanence and immortality, that they stop seeing the existential threats that are right around the corner.
But is that a fair comparison? I mean, to play devil's advocate, Google has a virtual monopoly on search, which is a massive cash cow. Motorola was just a hardware company.
And that's the counterargument. That's the bull case. Google has a $400 billion a year revenue stream from advertising. It's a much stickier business model than selling physical phones. But, and this is the giant but in the room, isn't this AI transition the exact same kind of paradigm shift that killed Motorola?
If your core product, search, becomes obsolete.
If search as we know it changes or disappears, that monopoly evaporates overnight, and all of a sudden, that 100-year bond doesn't look like a clever financial instrument. It looks like a tombstone.
It's a real check your ego moment for the entire industry. And speaking of egos, let's pivot to the company that's supposedly the main beneficiary of all this insane spending. Let's talk about NVIDIA.
The king of the hardware.
Yeah.
The one selling all the shovels.
You would think with $680 billion being spent and a huge slice of that going directly to GPUs, that NVIDIA would be popping champagne and planning a victory parade.
And in terms of revenue, they are. They're popping the champagne. They just hit another record $57 billion in revenue last quarter alone. The numbers are breathtaking.
Right.
But the stock has been weak. It's down today.
So what's the disconnect? If they have a monopoly on the most important resource in the world right now, why is the stock slipping?
There are two big reasons, one short-term and one very, very long-term. The short-term reason is insider selling. Senior insiders at NVIDIA, we're talking about the top executives, have sold over $100 million worth of their own stock just since the beginning of 2026.
That is never a good look.
It's not.
Yeah.
You know the saying, when the people running the kitchen suddenly stop eating in their own restaurant, you start to worry about the food. It suggests they think the stock price might be as good as it's going to get for a while.
Okay, so that's the short-term signal. What's the bigger long-term threat?
The long-term threat is what we call the in-house chip problem.
Unpack that for us.
Okay, so we said Amazon is spending $200 billion. But they are not just handing all of that money to Jensen Huang at NVIDIA. A very large and growing portion of that money is going into designing and fabricating their own custom AI chips. Trainium for training, Inferentia for inference.
Right.
And Google is spending $180 billion. A lot of that is going towards their own custom TPUs, their
Yeah.
tensor processing units. Meta has their own custom silicon designs in the works.
So NVIDIA's biggest customers are all spending billions of dollars to actively try and become their own suppliers.
You're trying to become their competitors.
Yeah.
That's the existential threat for NVIDIA. And the logic for Amazon and Google is simple. It's cost and availability.
Right.
NVIDIA's top-of-the-line GPUs are incredibly expensive, and for a long time there was a huge wait list to even get them.
If you're Amazon and you can design and do your own chip that is, say, 80% as good as NVIDIA's, but it costs you half as much and you can get as many as you want whenever you want.
You're going to use your own chip for your internal needs every single time. Every time. And that slowly eats away at NVIDIA's total addressable market. The moat that everyone thought NVIDIA had might not be as wide or as deep as we thought.
And the market is starting to price that risk in.
Exactly. And at the same time, we're seeing this massive, brutal rotation in the market. As investors are getting nervous about the big spenders, they're selling off what the market is now calling the AI losers.
And who are the AI losers?
It's any company whose business model is at risk of being completely destroyed by the very AI that NVIDIA's chips are powering. Think about certain software-as-a-service companies, legal research firms, data management companies. Any business that acts as an intermediary for information is at risk.
Investors are fleeing those sectors.
They're fleeing them and putting their money into safer assets, like treasury bonds. And it's not just the software companies. Look at a company like Cisco Systems. They just fell 12% in a single day. Why? Because the price of high-bandwidth memory chips, the kind you need for AI servers, is skyrocketing, and it's just eating their margins alive. The market is mercilessly hunting for anyone who gets hurt in this new world order.
It's a brutal rotation. But if we want to talk about brutal pivots and high-risk strategies, we have to talk about Tesla.
Oh yes, the ultimate all-in bet.
Elon Musk is doing something extraordinary. He is trying to pivot the entire identity of the company. For years, we thought of Tesla as an EV company. You buy a car, you drive it, it's electric. Now he is explicitly stating that they are an autonomous vehicle and humanoid robotics company.
It's a truly radical shift in strategy. And it's not just talk. The spending is backing it up. As we said, they're doubling their capex to $20 billion in 2026.
And what are they cutting to make room for that? Because I read something in our notes that just floored me. They're actually discontinuing some of their car models.
Yes. The latest reports indicate they are officially discontinuing the Model S and the Model X.
The two cars that literally put Tesla on the map, the cars that made the brand.
Gone. Phased out. And the official reason given is that they need to clear out the factory floor space to build the new production lines for Optimus,
The robot.
the humanoid robot, and for the dedicated robotaxi production lines.
So let me get this straight. He is killing the production of profitable high-end cars that people are actually buying today to build factories for robots and self-driving taxis that, well, let's be blunt, don't really exist at scale yet.
That is the gamble in a nutshell. And you have to remember the context here. Tesla's stock trades at something absurd, like 200 times forward earnings. It's priced for absolute perfection. It's priced as if this pivot to robots and autonomy has already happened and has been a wild success.
Well, what's the reality on the ground?
Well, this is the reality check. Tesla makes big claims about having robotaxis operating in cities like Austin and San Francisco. But there are independent researchers who track these vehicles. And their data shows that out of 58 robotaxis deployed in Austin, only about 4 of them are actually operating consistently without a human safety driver behind the wheel.
4 out of 58.
4. So the gap between the marketing claim, we have a fleet of robotaxis, and the reality, we have 4 cars that can mostly drive themselves in good weather, is significant.
And what about the Cybercab?
That's the other part of the puzzle. That's the vehicle with no steering wheel, no pedals. Musk's plan is to mass-produce these. But here's the catch. That vehicle is currently illegal to operate on almost every road in America. It doesn't have regulatory approval.
So he is spending a chunk of $20 billion to retool a factory to build a car that isn't legal to drive.
Precisely. It's a massive bet on the technology working flawlessly and the regulators playing along. Musk himself has said that Optimus, the robot, will eventually be 80% of Tesla's total value. If he's right, the stock is an incredible bargain today. If he's wrong, or even just too early, that valuation is completely unsustainable.
It is the ultimate high-wire act with no safety net. And speaking of regulators, we have to pivot to the political arena. because this part of the story is getting very, very messy.
This is extremely messy. And it's really important that we stick directly to the facts of what happened here because the topic gets emotional very quickly.
Absolutely. We're just reporting on the situation. So on February 12th, which was just yesterday, the chairman of the FTC, Andrew Ferguson, sent official warning letters to Apple CEO Tim Cook and to the leadership at Google.
He did. And you have to understand, these weren't your typical bureaucratic letters about a pending merger or something. These were direct accusations of political bias in their core products.
And the products in the crosshairs are Apple News and Gmail.
That's right. The letter to Apple accuses Apple News of, and this is a direct quote, systematically boosting left-wing sources while suppressing right-wing sources. And to back this up, he cites a report from an organization called the Media Research Center.
And for Google, what's the accusation there?
For Google, he's accusing Gmail of partisan filtering in its spam detection. The argument is that Gmail's algorithm is more likely to send Republican fundraising emails to the spam folder than it is Democratic ones.
And what's the legal threat here? How does this even fall under the FTC's jurisdiction?
That's the crux of it. Ferguson is making the argument that this kind of bias violates the FTC Act's prohibition on unfair or deceptive practices.
How does that work?
The logic, as he lays it out, is this. If your company's terms of service claim that your platform is neutral, or even if consumers have a reasonable expectation that it's neutral, and you are secretly tilting the scales one way or the other, that's a form of fraud. It's a deceptive practice.
That feels like a really novel and maybe aggressive interpretation of the FTC's power, doesn't it?
It's a brand new legal theory, to put it mildly. And it immediately kicks off a huge constitutional debate. On one hand, you have Republicans who have spent years arguing that the government should not be coercing private companies on speech. You remember the Murthy v. Missouri case?
Yes, where they sued the Biden administration, arguing they were pressuring social media companies to take down posts about COVID.
Exactly.
Yeah.
The argument was that the government can't use threats to get private companies to do its bidding on speech. But now, critics are looking at this and saying, well, isn't Ferguson, a Republican appointee, doing the exact same thing? He's using the threat of a massive, expensive federal investigation to pressure Apple to change its news algorithm. It's the same kind of coercion, just from the other side of the aisle.
There's a specific analysis in our research here that I want to touch on. It drew a very stark historical parallel to make its point, and I want to be crystal clear. We are simply relaying this analysis of the tactic being used.
Yes, this was a fascinating and admittedly dark structural analysis. It's important to stress that it's not a direct comparison of people or ideologies. It's an analysis of the mechanism of state control.
The mechanism argument.
Exactly. The author compares the structure of Ferguson's tactics to the early phases of press consolidation in 1930s Germany. And they point out three key similarities in the mechanism. First, you frame the government coercion as consumer protection, or back then, as protecting the press.
You give it a benign name.
A benign name. Second, you use vague, undefined standards like reasonable consumer expectations or community interests to enforce ideological conformity. And third, and this is the most important part, is the use of economic coercion.
Meaning you make it cheaper to comply than to fight.
Precisely. The government makes the potential cost of resistance a multi-year, $100 million FTC investigation, a plunging stock price, so terrifyingly high that it's just not worth it. The cost of compliance, quietly tweaking the algorithm to show a little more content from one side, is basically zero. So what does any rational, fiduciary-minded CEO do?
They tell the engineers to tweak the algorithm.
They tweak the algorithm. And this is what the analysis calls the choke point theory. You don't need to pass a big, scary censorship law. You just apply immense, quiet pressure on the intermediary, the choke point, Apple or Google, and you get them to alter the flow of information for you.
It creates this dangerous scenario where the news you see isn't being determined by what's popular or what's true, but by the implied threat of government action.
And that ties everything we've talked about together, connects back to the century bond and the utility theme. If these companies are now so big and so essential that they function as the world's information infrastructure, and they're so expensive to run that they need nation-state level budgets, at what point are they not really private companies anymore? At what point do they become public utilities subject to state control?
A very chilling thought. So let's bring this all back to the investor. With all this chaos, what's the sentiment out there on the street?
It is completely divided. It's a tale of two markets. You have Wall Street analysts, the big banks, who are still mostly issuing buy ratings. They're telling their clients to buy the dip. They're still projecting, for example, 29% upside for a stock like Meta. They're playing the long game.
But what about the retail investors, the people on Reddit, on StockTwits?
They're out. They're profoundly bearish. They see this massive spending as reckless. They're having flashbacks to the metaverse spending, calling this Metaverse 2.0. They see the margins collapsing, they see the cash flow drying up, and they're taking their money and running for the hills.
So it truly is the prove it year. As you said, 2024 and 2025 were all about the hype. 2026 is about execution.
It's all about execution. And the market has zero patience right now. It is punishing anyone who spends money without showing an immediate tangible return on that investment. If you tell the market you're spending $20 billion on robots, you better be able to show them $20 billion worth of robot-driven profit, or your stock is going to get hammered.
And with the valuations where they are, you mentioned Tesla at 200x earnings, but even Microsoft is still at 25x, there's just no room for error. None.
Absolutely none. The real danger here for long-term investors is the risk of a lost decade.
Yeah.
It's a scenario where the capital requirements, the sheer cost of buying all those NVIDIA chips and building all those data centers consistently outpaces the money they can actually make from the AI services. If that happens, these stocks could go sideways for 10 years. They could completely stagnate, even if the technology itself is revolutionary.
That's such an important point. Just because the technology is real and world-changing doesn't automatically mean the stock is a good buy at any price.
Exactly. The railroads were real. They changed the world. But an awful lot of railroad investors in the 1800s went completely broke because the capital costs of laying all that track were just too high. We could be seeing a digital version of the exact same story play out with AI.
So as we wrap up this deep dive, it's clear we are watching a series of historic gambles play out in real time. We have a $680 billion collective bet on building a new kind of global infrastructure. We have a 100-year financial bet on the very survival of Google. We have Elon Musk betting the entire company on robots. And all of this is happening while the government appears to be making a move to seize control of the algorithms that run it all.
It is, without a doubt, the most complex, high-stakes, and uncertain environment I have seen in 20 years of following these markets.
So I want to leave our listener with one final provocative thought. You brought up the utility comparison earlier. If these tech giants really are becoming the essential infrastructure for the 21st century, the new water, the new electricity, and if they require 100-year bonds and nation-state levels of spending just to stay in the game, at what point do we stop treating them like regular private companies?
And if those FTC letters we discussed are any indication, has that process of exerting state control already begun? Not through loud public legislation, but through the quiet, coercive threat of the algorithm.
Something to think about while you're watching that sea of red on your screen?
Indeed.
That's all the time we have for today's Pro Ticker Deep Dive. The landscape is changing faster than ever, so keep your eyes open. We'll see you next time.